Welcome to today's segment of The Power of Money. I'm your host, Michelle Graves, nationally known as the Money Lady, representing over 36 years of expertise and experience in the industries of insurance, banking, finance, credit, you name it, I've done it. But today I'm delighted to have for the next hour a gentleman who has been involved and is an industry expert on a subject that I'm going to be dealing with all of this year, 2013, and that subject matter is the elephant in the living room, long-term care. And for many of you that are not familiar with long-term care and why it is so essential and why I have to talk about it, is because it's here and it's not going away. And now that we're seriously into the whole realm of health care and preventive care and aging and all of these things that are converging on our country, you need to know. Why? Because most of you are going to need to have some form of long-term care as you age. Now, for the record, everyone has long-term care, whether you like it or not. If you are poor and indigent, that long-term care is known as Medicaid. If you're not poor, you'll either pay for it out of your own pocket, dollar for dollar, or you will have to consider a private plan to help to offset those costs. So I'm just sharing with everyone, you're going to have an opportunity to pick and choose, and so many of you aren't even going to have that opportunity. It is going to come at you fast. So today it's about education. It's about bringing you an individual who is a long-term care specialist and who can talk to you openly about the challenges. And we're actually going to do a case, which is people are like, well, what does it look like? What do I need to do? How can I afford it? And we're going to talk about that. And we're going to talk about it with one of the nation's top specialists. So again, without wasting a lot of time, because we've got a lot to cover, and you're going to want to know everything that he is sharing for your benefit today. So, Mr. Gallas, nice to have you here.
Thank you, Michelle, and Happy New Year to you as well.
Thank you for being here. And we just want to get right into this because we've got a lot to cover, and I'm counting on you to help my viewers through this maze called long-term care. It's becoming more and more an issue today, mainly because of the aging of America. And I'd like for you to just open it up by stating what the problem is and what your thoughts are.
Well, let me give you just a little background on me, just a little bit here.
Please do.
Basically, I grew up in a little town in Pennsylvania.
Okay.
And after leaving college, I went into the United States Air Force. So I've been in the Air Force for 25 years, retired Air Force, and got into financial planning. I know it seems kind of like a large, why did you do that? But it was just want to do something different. The financial planning was a great stepping stone for me to get into the long-term care, because during that time I was doing plans, I noticed that there was something missing. It was called what I call the missing link in a financial plan, and that was the long-term care element. I became so interested and passionate about it that I decided to just devote my time full-time to long-term care. So I left the registered representative business and got into long-term care, and now I'm the owner of the long-term care insurance agency, which is located in Kettering, Ohio. That agency has been there for 15 years, and it was set and established by Mr. Ray Copenhaver, who I think you had on your program.
Oh, he's an amazing gentleman.
A few weeks ago.
He's amazing.
Yeah, and I watched that, and Ray did an outstanding job.
Yes, he did.
And I get back to your first point. You're right. We do have a crisis in America. We really do. And it is called long-term care. A lot of us just don't think we're going to need that care, but you and I and millions of other Americans know that long-term care is here, especially for those of us that are kind of getting into those senior years. And as Ray mentioned, every day 10,000 Americans turn age 65, and that's creating a problem of 78 million baby boomers who are looking for solutions.
I think I like what you just said, that 78 million,
78
which
million.
I'm one of them. We're looking for solutions and answers.
Yes.
May not like the solution,
right,
but we need a solution.
Right, and all of us have experienced some sort of long-term care situation, whether it's a family member or a friend, some relatives, and we know the amount of work it takes and the amount of caregiving that's required to be in a long-term care or an extended care situation. And that's one of the main reasons why we exist. I mean, our agency exists here simply to provide that understanding and to let the viewers know that there's tremendous opportunities out there for them to put together a plan. And that's why we're here, to help them do that, to help them design a plan that will work for them and of course, you know, their friends and relatives also.
So tell me definitionally, what is long-term care?
Well,
as opposed to Medicare, because we hear this all the time.
Right, and I think Ray kind of explained a little bit about what long-term care basically is. Any type of chronic care or illness that you might have, say, and it can happen at any age. I mean, I think a lot of times people get the idea that, well, Randy, we're just not senior enough or old enough to have long-term care. Long-term care could happen at any age. For example, say a 20-year-old or a 25-year-old is involved in an automobile accident and would need therapy and care for maybe years. A lot of the insurance plans won't cover that. So long-term care basically is there to provide that extended care or personal care until that person gets rehabbed and back into the mainstream of life again. So really it's that care that is used basically you know, in type of, it can be a skilled care situation, it can be a custodial care situation where you're getting personal care, things like that. But it's care that's not normally conducted by a doctor or anything like that.
Okay.
It's personal care.
But it's needed because without the ability to eat or to take care of oneself,
correct,
then here you are.
Correct. And the definition basically to long-term care was established by HIPAA, and that was back, everybody here knows what a HIPAA is. When you go to the doctor, you filled out that. But it established 6 criteria, and it's what they call activities of daily living. Things that you and I and most Americans did this morning, like bathing, getting dressed, eating, having breakfast, maintaining continence, personal hygiene, things like that, transferring, getting up. I mean, those were the 6 elements of activities of daily living that they use as a definition for long-term care.
So what is the ideal age to begin looking for this type of coverage?
That is a very good question. The age group has actually come down in recent years. It used to be in the basically high 60s, and now we're seeing that and we use it in terms of a sweet spot sort of thing, about the age of 58 is what we're seeing. Nationally, 58 is the age that people start thinking or considering a long-term care you know, sort of plan. Mostly because the children are grown up, they're out of college, they're out of the house in most cases, you know, they're seeing mom and dad that may be in an extended care situation or going through this, you know, for themselves personally, and as a result, that starts getting them thinking. And like I had mentioned, and I'll give you an example, like my mom, for example.
Okay.
She developed Alzheimer's about 3 years ago. And she's in a memory care unit in Pennsylvania, and I'm very fortunate to have found a facility there that to me is just top-notch quality when it comes to long-term care. And this facility does a lot of things in terms of Alzheimer's, in terms of the memory care. They keep her active, they keep her brain active, they just don't let her sit there all day.
Right.
In fact, she's never in her room. So if I call her, well, mom's in an activity right now.
Okay.
And that's, you know, you don't know how comforting that is to me and to my brothers as well, because we know she's getting quality care and we don't have to worry about that. That's the good news.
Okay.
The bad news is mom didn't have a long-term care policy.
Oh my goodness.
So,
so
we've probably spent, I would say, between $120,000 and $130,000 on her care.
Okay.
So, and that's kind of the problem that most of us are going to see happen if we don't have something in place to take up, you know, some of that cost when it comes to long-term care. So, you know, it's good that she's in a great facility. It's bad the fact that we have to spend down some of Mom's estate to keep her there.
Well, the blessing is she has an estate to spend down.
That is a blessing.
For quality facility, because so many people have, through many times just poor planning, have very little. And then they're going to be looking to the family to step to the table to provide some level of monetary
Yes.
payment. Is that fair?
Yes, that is true, and we see that happening. When you take a look at you know, families, the lifestyle today, it's different than it was 20, 30 years ago.
It surely is.
Right?
It
I mean,
is.
husband and
It
wives
is.
are both working to make a living, you know, to make ends meet. And then if there's a situation where there's a family member that needs care, I guess the question is which one of the family members are going to quit their job to take care of mom or dad?
And can they?
And can they?
Right, because people are in a struggling mode now just to keep their jobs.
Yes.
So
yes.
how can that? So long-term care would be insurance to pick up that slack, correct?
Exactly. That's exactly. It covers that gap, or it fills the gap between your personal assets that you have to use for maybe some extended care, and it just fills that particular void that you would have in your financial plan. That's why it was so important to just sit down with a specialist and let them kind of go over that. And let me say another thing. Financial planners have a major impact in part of this whole long-term care. When we work in our agency, we work as a team with the financial planners. We also work with estate planning attorneys. So it's a team approach. We want that client that's sitting across the table to have the best available options available to them when a, quote, crisis strikes. So we want to make sure that they're well taken care of and they don't have to go through all the emotional and financial, what do we do next sort of thing.
Do you, because you do work with estate planning attorneys in your market, do you find that most attorneys, unless, let's just not deal with estate planning attorneys, but would you say that legal professionals are aware of this need?
Some definitely are aware of this need. And I think that's because they're seeing a lot of these things happen. Like I had mentioned, with 78 million baby boomers, I think they're seeing more of it. And that's the reason why we try to partner and work with them as a team in order to give the best available solutions and options to a husband and wife.
Okay. I would think that as people are having to deal with their parents and the issue of parental aging, and dealing with many times the financial responsibility that takes place when your parents are now aging. And they're in denial. Most of the parents are in profound denial, which is happening right in front of me. The children are finding themselves burdened with having to pay for many of these types of things, would you say nursing homes and stuff, or even at-home care, paying for someone to come and take care of mom and dad.
That's true.
Does that become an expense of the children in so many cases?
It can. In fact, there's actually some states that say that the children will be responsible for paying for mom and dad's care.
Oh my goodness.
Yeah, it's called a codicil law. And again, I'm not an attorney, so I don't want to get into that. But there are certain states that say that once mom's estate has been spent down, that the children are now on the hook for paying for mom and dad's care.
My goodness gracious. So this can be at least minimized by making those decisions that this is not an option. And this is what I've shared with people, Randy, over the years. This is not an option. You can't possibly talk to me about maximizing your returns on investments and equities and mutual funds and exchange rate, and you haven't taken care of a foundation, something that is so foundational that you will probably use.
Exactly.
I mean, isn't it like 69% of people?
That statistic is a national statistic that's put out by the Department of Health and Human Services that says 70% of us after the age of 65 will need some sort of type of care. We don't know what that is. It could be a home care setting or assisted living or something, but that's a pretty high number, and it's pretty frightening.
It is very, when I saw it, it was very frightening to me.
Right, and so I think we all have a responsibility to at least look into the long-term care planning aspect to see what does it encompass, and what are the costs, and what are the benefits that we can get from a policy.
Okay. Let's talk about the little-known state partnership plan.
That's a very good question. First of all, let me say that the Ohio Partnership Program for Long-Term Care has been in existence since September 2008. That's over 4.5 years almost. And I would say less than 10% of the Ohio residents are even aware of this program. That's part of why our agency exists, so that we can make these sort of tools and things, information available, because when we talk about the Ohio Partnership, most clients will say, we never heard of that program. There was a mailing campaign that did go out when that program kicked off back in September of 2008, that was sent out to about 1 million Buckeyes, really, in the state, between the ages of 45 and 65, that outlined a little bit of the parameters of that program. But again, we get so much mail today.
Yes, we do. Yep,
it's
in
just
the
like
garbage
it may
can.
not have gotten into the, opened or gotten, read or whatever. So we have a little brochure here if you want to show that brochure.
Okay.
It is put out by the Department of Jobs of Health and Human Services, and it actually describes and explains the partnership program and the qualifications for that program.
And they can get a copy of this by contacting your office?
Absolutely.
Okay.
We have lots of materials that in our office that we use that are a lot more on the marketplace today than there were maybe 5 or 10 years ago. Only because of the awareness of long-term care is even more so today than it's ever been. And so we take advantage of those things. And some of the carriers do a great job also in reprinting a lot of things. In fact, there's another guide here, if you can show that.
Okay, surely.
It's called the three-step guide. Three-step guide to long-term care, smarter long-term care planning. It was reproduced by John Hancock, and it was also put together by Kiplinger. So, so there's some very good sources out there that we use. And here's another one too. It's about long-term care planning, all the W's, the who, what, when, where, what is long-term care, and those sort of things, most frequently asked questions. So
and this is put out by?
Same thing. It was put together by, this was put out by Genworth, I think. Genworth put this particular brochure out. And we have copies of those in our office that we get, and be more than happy to provide those to anyone that requests them.
Now, what is this?
This is great. This is a document that the state of Ohio, it's the National Association for Insurance Commissioners, puts out. And it basically covers everything from A to Z on long-term care. So
everything?
Everything. So if you wanted to know how Medicare works or Medicaid works, or what's the definition of home health care or assisted living or nursing home, it's outlined in this brochure.
Excellent.
And that is something that is a requirement by the state. Anytime we meet with a client, they have to have a copy of that.
Oh, really?
So that's called the Shopper's Guide.
Okay, and that just kind of gives an overall framework for long-term care?
Correct.
Okay.
Gives an overall framework.
Okay.
And what we do is we've taken this document and we've basically put together a presentation. So when you come to our office, we have what we call the White Book presentation, or Long-Term Care 101 is what I call it. And we use a lot of the information that's from the Shopper's Guide.
Okay, all right. So with the state of Ohio, because what I'm excited about, actually, is the fact that the greatest fear of most people, I think, seniors particularly, is dying and having nothing to pass on to their heirs. They've exhausted all of their savings for their long-term care needs.
Correct.
And whatever they haven't exhausted, like their house or something, becomes subject to recovery, asset recovery by the state, all the states, I believe. But under this long-term care partnership, how does that work?
Well, first of all, let's talk a little bit about the carriers.
Okay.
You want to make sure that you have a carrier that's going to participate in that program.
Okay.
All the carriers that we represent, and there's about 14 that we represent, there's maybe only 1 or 2 that's not partnership certified.
Okay.
So we try to put a client with a plan that has a partnership arrangement with that. And all that partnership arrangement means that if you have a long-term care policy and it is partnership, that you are exempt from a state recovery. And so you get to protect some assets, and that's a very key thing. So when you mentioned about the spending down sort of thing,
Right.
at this point, depending upon what your policy is worth, and let's just say you had a policy was worth $250,000, you would get to protect, and I always say put a fence around that $250,000 where you would not have to, quote, spend that down for your long-term care. And there is
That
with
is
the partnership.
powerful.
That is very powerful. And you'd be surprised.
That is powerful.
People just don't know that.
So let me be clear, because, and I don't want to sound redundant, but this is very important what you're sharing.
Yes.
If 69% of us
Mm-hmm.
over the age of 65 are going to need long-term care,
Mm-hmm.
and that is a dollar-for-dollar expense, and it's significant. I think the
Yes.
stats are sobering, what
Right.
you're going to spend even for in-home care. So if you have a carrier product where the carrier has been certified
Mm-hmm.
under this partnership program,
Mm-hmm.
those monies spent for your care would be exempt from a state recovery?
That is a true statement.
Is that the truth?
Yes.
That is amazing.
It is very powerful. There are.
Why would anybody not do this?
Well, well, your program is hopefully getting that information out
Well, I
today.
told you, I'm coming 2013. I'm going to be talking about this until people are sick of looking at me, because I see this as a train wreck coming. You can't have this many people coming out of the workplace, retiring, and spending down their assets to live, and then
Right.
find themselves penniless
Right.
with no legacy for their
Right.
children and grandchildren or church or whatever.
Correct. And the state of Ohio is very kind, very good. In fact, if you have a long-term care plan in the state of Ohio, that premium that you pay is fully 100% tax deductible. And most people don't know that
Are
either.
you serious?
So there's even more benefit to having that.
The premium is
It's tax
tax deductible. Is that that state? Is that federal?
Federal
know?
depends on, it can be, it just depends on what your cost of medical services would be. If
Okay.
it's like 7.5%, they use a number of 7.5% of adjusted gross income. And if it calculates in there, yes, then you can deduct a portion of that premium off of your federal income tax. Now the solution would be, and I'm not a politician, but the solution would be for Washington to say, you know what, there's, we have a solution here, and it's called, why don't we offer that same sort of benefit to Americans that buy long-term care policies?
To write it off in their taxes.
Exactly.
Because it's saving the government
millions of dollars.
millions of
or
dollars
more,
or
probably
more. I
Yeah.
mean, this is a train wreck. I don't
Exactly.
know how in the world, and I know we've got fiscal cliff and debt issues, but this little thing, and it's not little,
No, it's not.
is troubling, because that's the thing that's not showing on the federal balance sheet,
Exactly.
which is contingent liabilities to fund this humongous
Elephant in a room.
elephant in the living room.
Right.
Jeez.
Yes.
Can I had a situation, can a person who owns a business, can they write it off as a business expense? Do you know?
The answer to that question is yes. It depends on whether or not the type of corporation that it is.
Right.
If it's a C corporation, 100% of that premium can be written off through the business.
So a C corporation can
Right.
write 100% of this off?
Absolutely.
Are you serious?
Absolutely. S corps also
Oh.
have a deduction. LLCs, sole proprietors. There's so many avenues. So there's so many different benefits associated with having a plan. For a business owner, it's great. In fact, at some point in time, if your program permits, maybe we can do something like that just to share with the business owners how powerful this would be for them.
Oh, I'll bring you to talk about that,
Great.
because business owners fuel America.
Exactly.
And at the point that could be available,
Yes.
That is very, very, very
Mm-hmm.
powerful.
Mm-hmm.
This is good. I'm perky now. I'm actually
Well, now
like,
you,
whoa, wait a minute. This is very, very good information. So there really is no excuse for a person to not have this, other than I hear all the time, it's cost prohibitive. Because this, unlike automobile insurance and home insurance, this is a benefit you're going to use.
probably.
Yes.
Yes.
So insurance companies are not social service agencies,
No.
and so they're going to have to price their premiums
Right.
to cover the probability of you using the product, correct?
Correct.
Which at 2/3 means that they're going to have to cover their expenses.
Yes.
So
Yes.
let's talk about that. How does that work out? How are insurance companies, because I've heard a lot of scuttlebutt about that.
In terms of the premiums, you mean?
Yes.
Well, of course, you know, the country is in this, going through that economic, you know, situation that we have here with interest rates. So it did create a little bit of a burden on them. But the good news there is, I think we're through that. I think we're beyond that now.
Mm-hmm.
And they've set their pricing, and their bar is set where we hopefully won't see anything like that again for many, many years to come. But it's just like anything, you know. I always ask the client, I says, when you were growing up, did you ever think you were going to pay $4 for a gallon of gas? And they says, no way,
No
Randy.
way,
We would have
man.
never thought
What
about that in a million
59
years.
cents a gallon. I mean, please.
Or in my case, 33 when I was growing up.
Well,
But you're much younger than I am. But anyway.
Yeah, right. Okay.
But yes, I mean, what's the chances of that? I mean, it's healthcare, and healthcare costs are going to continually increase. So the best solution is to lock in something when you're young, and when
And
you're
lock it
healthy.
in.
Yes, and when you're healthy.
Right, and healthy.
Exactly.
So actually, we're looking at the possibility of people as young as maybe 45.
Actually, I do have clients that are in their 40s that have taken long-term care.
Really?
Yes.
They're smart.
Yes, they are smart, and
So they
it's,
locked in their good health, so they had to have gotten better rates.
absolutely. And you know, we have a client list all the way from in the 40s up into the 80s. In fact, we have a lady that just came in. She's 84. She's doing a long-term care policy. And you may say, 84? Well, why would you need a long-term care policy? When she says that I plan on living 10 years past my mom's age and her mom is 106, I'm
Okay.
thinking that's maybe 30 years from now.
Exactly.
And some seniors, they're very, very active. I mean, this particular person plays tennis. And she is a day trader in the stock market. And it's like, that's just...
Wow, that's
just
wonderful.
Yeah,
But
yeah.
that is kind of scary, because the reality is that she's now technically classified as elderly,
Yes.
and therefore the possibility of her having injuries is greater.
Maybe a little bit higher.
Yeah, maybe a little bit higher.
So she would,
Okay.
she would pay a little bit more for that premium.
okay.
But that's okay. I mean,
But still, isn't it not, instead of dollar for dollar, you're still getting an insurance discount,
absolutely.
which
Absolutely.
is, explain that concept so people could understand what that means.
I actually I make it a pretty simple way of calculating that. I'll take sometimes a premium, which like is an annual premium,
Okay.
and we'll just use $2,000. And if they had that policy for, say, 20 years, they've spent how much? $40,000,
Yes.
right? And so then you have to take that $40,000 and divide into what's that benefit? Well, that benefit may be $500,000. So you're looking at purchasing a policy that may be like 10 cents on the dollar or 12 cents on the dollar. So I'll always ask them, I'll say, do you have a dime in your pocket? And they'll say, yeah. I says, put it in the table. They'll put the dime on the table, and I'll say, now the insurance company, and that's me, I'm going to put $1 to match your dime. Well, where else can you make that happen? You can't.
You can't
So
do that in the
You
market.
cannot do that in the market. Well, you might be able to do it in Vegas if you're lucky.
Yeah, if you're lucky. If you're lucky.
But that is the leverage potential that long-term care insurance has. It has an extremely amount of leverage for very few dollars that you're spending for that policy.
And yet, the reality is, again, without sounding redundant, the elephant is in the living room. And he's not going to go away.
No.
No. Period. You're going to pay one way or the other.
Yes.
So you either pay pennies for dollars with the long-term care policy, correct?
Correct.
Or you pay out of pocket.
Yes, that's a solution.
Yeah, you just fund it yourself and
Self-insure.
and hope you don't run out of money.
Right.
Or you turn to Medicaid after you run out of money, and now you ask the government to take care of you in today's economy. Right.
Right.
That is very, very
Scary.
scary,
Yeah.
Randy.
Yes, Michelle, it is. And another reason why, you know, we need information out there to make this aware. I mean, we do long-term care. There's a 1 month that Congress has dedicated for Long-Term Care Awareness Month, which is November.
Right.
You know, and we try to do things like workshops and seminars and things like that to provide this awareness to the Miami Valley. So that's what we like to do and try to get this information out. All the information and things that we have, they're at no cost to you. I mean, you can come in, you can request them, we'll give them to you. Well, you know, we want you to be educated. We want you to have knowledge on what it is and what the problem is, and there's a little bit of a crisis.
Well, I don't think people have knowledge. That's why I'm delighted that you came on, because I really don't believe that the majority of people, if they knew what you shared with me on this show, if they knew this, there would be no basis for them to not at least allocate monies from their portfolio. That's an investment in yourself.
It is.
So some of that money needs to be moved in another direction, wouldn't you say?
Absolutely, and there's where the teaming comes with the financial advisors. They can help in that process, basically, because they know that client's financial plan. They know where they could take dollars to pay for that premium, whether it's dividend income or whatever type of it would be at the end of the year. It's basically a through, and yet they have this tremendous amount of leverage to use for long-term care, and they don't really feel that pain at all anywhere in terms of their financial plan. So
but it's there.
It's there.
It's definitely there. I can't imagine, as I shared, and I'll continue to share, do not come to me for financial advisory services with regard to retirement income planning, and you have not addressed this, because that is major, but it is overlooked so often. I look at cases, and I'm glad today we're going to talk about a case. Maybe this is a good segue. Have we covered at least the foundational issues, you think?
I think we have covered pretty much, just, what that is. And I'd like to talk a little bit about, the process that we use at our agency and how to make it so simple for you. I mean, we don't, I think everybody thinks it's a very complex and complicated business, to do.
I did.
Yes.
And it's not.
It isn't. And we try to make it extremely easy for you to understand. And we've developed some tools that I just love them. I think that when a client comes in and they walk out, they would be able to talk to their children, their next door neighbor, and explain it in entirety. And you say, how can that possibly be? Because we try to make it work for you to understand. We want you, this is your product, we want you to understand how it works when you need to use it.
Well, let's start with a case study.
Okay, we can do that.
And how this works and what are the things, the questions. Viewers, I'm going to take Randy down a road and just pretend I know absolutely nothing. And if that sounds like you, that's great, because most people completely gloss over and glass over when you start talking about financial services anyway. But we are going to talk about this from the perspective of a couple, Fred and Wilma Flintstone. I love them. And Barney, he's not included. But we're going to talk about what is involved and what you need to do in terms of getting started. We're going to take you behind the scenes and let you see what Randy looks at and how he's able to help you to make those decisions. So, where do we want to start?
Okay, let's do that. Before we get into our chart that we had prepared for this, the first step in this whole process is what we called a fact finder,
Okay.
or discovery, or whatever you want to call it. But it's a one-page statement of health that we use. And it basically gives us an idea of what your health is. We may ask you some questions like, have you had cancer, or what type of cancer, whether or not you had diabetes, whether it's type 1 or type 2. We need to understand and know some of those things because every carrier is different, and every carrier has different criteria when it comes to underwriting. So it's best for us to know that now up front before we go into all the heavy loading, so to speak, and putting all this together for a client. But let me say one thing. There's a lot of misconception out there. Sometimes I'll get clients that say, well, Randy, I had cancer, 5 years ago. It's been in remission, and I can't get long-term care. That's totally untrue. And see, those are the sort of things that's the reason why you want to come talk to us, because in most cases, if you had cancer and it was in remission a year, you would qualify for long-term care.
That is unbelievable.
Absolutely.
I didn't know that.
It's standard rates.
I'm so serious, and that is a major misconception.
A big one. A big one.
I mean, because I just assumed that if you've had diabetes, type 2, you're uninsurable.
Absolutely
Because
not.
at one time, Randy, weren't we uninsurable, people that had medical conditions and that type of thing?
Well, now see, there are some cases where, where you may not qualify, especially if you've had maybe 4 or 5 heart attacks.
Oh, well,
probably wouldn't work.
No, it probably wouldn't work. We'd have to do something else.
Yeah, exactly. And height and weight limitations. There are some height and weight limitations also when it comes to every carrier, and they're all different, of course.
Okay.
So,
and your benefit is that you represent a number of carriers.
Yes.
So you would know the profile versus one carrier.
Exactly.
Because I had this conversation with an associate, and I said, there's no way I would subject myself to just one carrier. Because all of them are different.
Exactly. Exactly.
And you're the expert.
And we know all the different carriers and what might be best for a client, and in terms of an affordable plan also. Because that's what we're here to do. We're trying to give them some level of coverage and an affordability, that fits their pocketbook.
Okay, we'll continue on.
Okay.
This is good. This is
all right, good. So we got the fact finder. So we've got a little bit of information on that and any type of medications they may be taking, okay?
Okay.
And then we kind of go behind the scenes, and we'll tell the client they'll give us a couple of days, and we're going to do some work on their plan. We'll go in and we'll check based on the information they provided us, whether or not, first of all, they are insurable, and in most cases they are, and we'll tell them right up front if they were not. Okay. Let me digress for a second. Every once in a while, we'll get a phone call that says, we're looking for long-term care for a mom. I says, okay. Can you give me some background on mom? Well, she's in a nursing home. Well, we see we can't do anything then. Mom's already in the nursing home.
Right.
So I said, well, you had to do this before that happened, So again, a lot of misconceptions and misunderstandings as to long-term care.
So if a person is in a nursing home, then the children will have to make a choice.
Correct.
And that is, again, either she liquidates her assets, the mother, or the father.
Yes.
And when those assets are exhausted, then the children either pick up the tab, or you move them on into the Medicaid world.
Environment. Yeah.
Which is poverty.
Pretty much, yeah.
Yeah.
Right. So, getting back, so I just wanted to throw that in there. But then we'll put together a plan.
Okay.
We'll put together a sign, and then we would call the client to come into the office. We'd like them to come to our office in Kettering, where we would sit down with them and explain to them, some of the technical parameters of what that plan would encompass. But we take that technical and we make it into simplistic terms so that they can understand it.
Right. People have to understand what their dollars are buying.
Exactly. Exactly. And there's where we go through what we call our white book presentation, or long-term care 101. And it depends on how much information or knowledge they have about it. But that presentation covers basically what is long-term care. It goes into the costs associated with long-term care, the risks associated with not having a policy and how much that would cost them. and just what does long-term care cover, you know, with some of the benefits that it
Okay.
covers in a policy. So we'll go through that process, and then we have what we call our top-level design chart.
Okay.
And that's one thing that I'd like to share here. We take information, we put it on a one-page chart that kind of gives them the complete description of their plan right up front.
Okay, so where do we want to begin?
Well, let's take a look at that chart.
Okay,
Can
I'll
we
take
do
a
that?
look at it
Okay.
with you. Okay.
All right, this is Fred and Wilma Flintstone's long-term care plan.
Okay.
So there's about 12 boxes on this page, but we're just going to focus, first of all, we'll go down from top to bottom, okay?
Okay.
Now, when we design a plan, we looked here at $4,000 a month benefit for each,
Okay.
if I say it was a husband and wife.
Okay.
So 4,000. Now, could we have used something else? Absolutely.
Okay.
We can go anywhere from $1,500 a month to basically up to $15,000 a month
Okay, and benefit.
in terms of benefit.
Okay,
Yeah.
okay.
So we can put the chart back up again. We'll take a look at that again.
Okay.
We'll just keep it up then we'll go through those boxes.
Okay.
So we use $4,000 a month. And when it comes to the period there, that benefit period, again, we can go anywhere from 1 year all the way up to 10 years. And in some cases, we used to be able to do a lifetime plan, but very few companies offer that today.
Okay, so they have a defined period that they'll pay out.
Right.
Okay.
But
all
with
right.
the Ohio partnership, we found that anywhere from a 3 to a 5-year plan is most acceptable, you know, and more cost effective.
Okay.
And also using data from around the state and around the nation, most people are in a long-term care environment for 3 years or less.
Okay, well then that fits perfect.
So it's a nice fit.
Okay.
So if you took 3 years, which is 36 months, then you just multiply that times 4,000, and you drop all the way to the bottom of that chart, they would each have a benefit of $144,000.
Okay.
That's
Alrighty,
it.
That's it.
That's their long-term care plan
Okay.
today. Not next week, not 3 years
Right
from
now.
today, but right today. So when they walk out of the office, they basically are covered, even though it hasn't gone through underwriting yet, because they filled out the appropriate paperwork and done all that. Now, there are some other things on there that we're going to look at, and that is inflation. If you go back to the top there, you'll go across and you'll see 3% compound.
Yes.
We can use 3%, we can use 3.5%, all the way up to 5% compound.
Okay.
Okay? We use 3%. Again, one of the reasons is because CPI, or inflation protection, has been running about 2.8 to 3.2 for the last 30 years.
Okay.
So we feel that's a good number to use. The higher the compound you use, the higher the premium will be.
Right,
So
right.
again, we're trying to get the majority of us into something that's affordable. And then if you look at that 3% compound, then drop back down to the bottom boxes again,
Okay.
you'll see that that $144,000 has now grown in 10 years to 193,
Yes.
and then has grown to 260 and
In year
20.
20? Yeah.
And in
okay.
year 30, almost $350,000 each.
Each.
So if
Each.
it's a 50-year-old, would they be around maybe at the age of 80? I would say absolutely.
I would think
Say
so.
the percentages are
I
very
would think
high.
so.
Well, wouldn't it be nice to have $700,000 worth of long-term care coverage? And you say, well, why would you need that much? It's because of inflation.
Right.
In 30 years, that's what the cost is going to be for long-term care.
Right. Okay.
So then go back up to the top again. There's things on here. It's called an elimination period, and that's like a deductible, like in your automobile. You have a deductible. You can get a 30-day, a 60-day, or 90-day, which just means that you'd be responsible for
all
paying
costs
up for
involved.
those
Okay.
first 90
All
days.
right.
Right. So in reality, there's only 3 boxes you need to put together a plan: the benefit amount, the period, 36 months, times multiply those, and you get 144,000. And that's the starting point. And then the rest of it is the future and how that
Okay.
plan grows in the future. Now, there are some other boxes there. If you can see those yellow boxes where it says shared care waiver and joint premium waivers, there's many different riders that you can put on a policy.
Okay.
Okay, and of course, the more you add, the more it costs, of course. But if it's a married couple, we would highly recommend the shared care.
Okay. Now, how does that work?
Let me explain how that works. Good question. First of all, you have a husband and wife. They each have a $144,000 policy.
Okay.
Okay. Fred, in this case, in year 20, decides to leave the planet and never use his policy.
Okay.
So Wilma's by herself. But what she has is she inherited Fred's policy.
Oh my goodness.
So
In full.
in full. So now how much does she have for her long-term care?
288,000?
Well, 200, is it 260?
Yeah, something like that.
Plus
yeah.
another 260?
Oh my goodness.
$520,000
So if he predeceases
her
Wilma
without using any of his
without
profit.
using his benefits, she will get that entire pot
Absolutely.
for the same premium amount that they've been paying?
No. In fact,
For hers only?
just for hers only. And that could be $1,000, $1,200 a month, whatever it is.
To be snarky here,
Mm-hmm.
but women do live longer than men.
Absolutely.
So she would be the benefactor of his
Long-term care
long-term
policy.
care policy.
Yes. So if their annual premium was $2,000
Uh-huh.
and Fred left us, and his
Yes.
was $1,000 and hers was
Okay.
$1,000, say her premium would be $1,000 a year, it would be annually, and she would have a $500,000 benefit.
That's nice.
That's incredible.
I mean, I'm thinking about all the females out here that are outliving their husbands and the
Yes.
widows who are truly, the nursing homes are full of women.
Yes.
They are, the long-term
That
stays
policy
are-
would provide extended care for a
And
very long period of
high-quality
time.
care for
High quality
her.
care. Yes.
Oh my goodness, that's wonderful. That is
So
wonderful.
We
Okay.
always highly recommend the shared care. We put that on a policy.
Okay,
for
as a
married couple.
given, uh-huh.
There's another thing in the middle there. It's called a waiver of home health care. Say you do have a situation where you're going to need care, extended
Okay,
care,
at
and,
home.
and the doctor says, well, Michelle, you can get your care in a skilled nursing care facility or you can get it at home.
Okay.
You would rather get it where?
Oh, I'd always want to be at home.
Absolutely.
Sure, there's no place like home.
So if that's the case, then that policy would pay immediately. So your premium would be waived and your policy would pay right away. You would be no 90-day elimination period
Oh my goodness, for
Right.
at home.
for home care.
Okay,
Right.
that's nice.
Right.
Okay.
So basically, that's the workings. Using that top-level chart is a great way to explain the benefits of a plan and to show them how that plan grows in the out years. And so,
Now, I understand the concept. Now let's put it into application.
you're going to ask the question, what is the cost?
Yeah, I'm going to ask, what's this going to cost me? The right hand of my firstborn child.
Well, again, remember when we went back to the discovery and the fact-finding
Yes,
stages,
yes.
we looked at a couple different companies. And we have 14 different carriers that we could have looked at. But based on that information that you provided me, we selected maybe 3 companies, like company A, B, and C.
Yes.
Okay? And then what we've done is we put together with those 3 companies, and we've tried to make sure that they're close to apples.
Okay.
Meaning we don't want way this is entirely different than that one. We want them all to be pretty close.
Right.
Now, every company has a little nuance in there, a little thing in there that makes theirs maybe a little bit better than another one. But that's okay. You know, we explain that, and we explain that. But we want them all to be the same, all compound inflation, all shared care, 3 years, whatever that number is. And so they're all the same. And then we typically start out maybe with a plan of $5,000 a month. And so we'd
Okay.
have like $5,000 and maybe $4,000, like the illustration showed there was $4,000, and then we'd have maybe one at $3,000 a month.
Okay.
And why do we do that? It's because we want you to have some choices. We don't want you to say, oh, geez, Randy, that was just too expensive, that
Right.
$5,000, and they leave. And it's like, well, we don't want you to do that. We want you to have something.
Right.
And before I go further, I have to just throw this in here because this just happened within the last 24 hours. I was at my office last evening and I received a phone call at 5:30.
Okay, end of the day.
And so I answered the phone, and it was a client that I had put together a policy for in 2006.
Okay.
So that was almost 7 years ago.
Yes.
And she had explained to me that her husband had Parkinson's and that they were going to need care.
Okay.
And she had already contacted the insurance company, and I says, okay, good. And the first thing I asked is, what was that relationship with the insurance carrier? Because I knew who the company was.
Okay.
And she said, it was outstanding, Randy. The lady on the other end was very helpful. She told me exactly what I had to do. The process, she sent me the right paperwork. We got
Right.
everything filled out correctly. And she says, but the purpose of this phone call wasn't to complain about anything. The purpose of the phone call was to thank you.
Oh my goodness, that's wonderful.
And
That's wonderful. This just happened.
within the last 24 hours.
Oh my, that's
And I
wonderful.
says, well,
kudos to you.
yeah, and you know how good that makes you feel when
Of
you know you've
course
helped
it is.
somebody? And she said that he's going to need care, my husband's going to need care, but we're
got
going to do it at,
Parkinson's,
yes,
okay.
Parkinson's, but we're going to
Okay.
use that home care portion of the
Okay,
policy,
okay.
which is about $120 a day right now. And
Okay.
she said, because he's wearing me out. And
Oh,
she
of
said,
course.
and I can't take time with my girlfriends or my family,
Right.
so we're going to use that policy, and it's all in place, and the company's going to start paying $120 a day for that policy.
Perfect.
And she said, you know, when you were here, we had questioned whether or not we were going to do this or not. We didn't think we needed it.
Mm-hmm.
But you were very persistent with us, and you hung in there, and you kind of showed us, you know, some of the risks that could
Wow.
be involved, you know,
Right.
by paying out of pocket. And she said,
Imminent poverty.
yeah. And so she said, and it doesn't really matter what the amount is, whether it's $3,000 a month or $4,000 or $6,000 a month. The important thing to remember is they had some coverage to help defray the cost,
Right.
you know, out of their pocket.
Right.
And so, you know, when I left, I felt really good about that.
Well, you
and,
should,
yeah,
because that's an actual real life testimony.
Right.
to-
It was kind of funny. It just happened.
But I think that's
Yeah.
very appropriate. And I think that the wisdom that she exercised and that couple exercised in going on and getting the coverage is just so important. That's why I said to you, 2013, that's going to be my mantra, get long-term care. Stop thinking it's not going to play out like that. Get long-term care. So with this particular couple, because our time is actually almost up.
I didn't realize that.
I know when you're
Too much
having
fun.
fun, it's
Yeah.
having fun. With Fred and Wilma,
Yes.
what was the final decision?
The final decision there was, they said basically the premiums ranged anywhere from like $350 down to well, actually it was $200 a month.
Right.
They picked something in between. So
Okay.
basically that plan of $4,000 was
Worked
a
for them.
perfect plan for them. And again, that's the whole purpose of this, to find something that they're comfortable with, and they have good coverage with a good carrier, and they're able to not have to worry about a long-term care situation.
Okay. Now, I hear this a lot from people, and that is that I'm paying out all this money. What if I never use the benefit? Is there a return of premium? Can they get their money back if they never use the benefit?
There is a provision that you can add to the policy. It's called full return of premium, yes.
That would have to be more
You can add that.
expensive.
Yeah, it's a little bit more expensive. It's about 40% more in
Yeah.
premium to add that on, but yes, it is available to you.
So if you never use the benefit, that money then passes on to your heirs, or
Correct,
does it?
to a beneficiary.
Okay, it does pass on to a beneficiary.
Mhm.
But you're going to pay for that.
It would cost you a little bit more.
Right.
There has one lady that did that. I did have a
Okay.
lady that did put a
She did
return
do
of
that.
premium on. She was single, and lost her husband, and she wanted to have, in case she never used that policy, be able to take those dollars she spent and return those to some grandchildren. So,
Wow, that's good. I think that the return of premium is an expensive option, but maybe for a single person, it might work for them.
correct, correct.
I think the challenge that remains is the issue of education and enlightenment. And again, your agency specializes in this, and has actually specialized in this before it became what it is today, which is this elephant. You all have been doing that. So my recommendation always would be that you deal with a specialist.
Okay.
And that you do business with people that are seasoned and that have a track record that would give them the customer a level of comfort in your level of expertise.
Yes.
Because I think this is such a tough thing. And to tell people that are dealing with the economy and uncertainty that you're going to have to take dollars that you allocated for retirement income and asset planning, and you're going to have to move those dollars into this kind of a policy.
Yes.
It would be hard to do if they didn't understand. And if they didn't know that in those statistics, the 69% and then 79% for women,
Mm-hmm.
I mean, we're going there. Planning can change the story. Is that a fair statement?
It can make life a lot easier and simpler.
I would think it would make life very, very easier. I don't know of anybody who can do caregiving 24/7.
We've seen it.
It's a nice fantasy, but it's not the truth.
It's difficult.
Well, would you give our viewers in the remaining time we have your telephone number?
Okay.
Okay. You do
Okay.
that?
Yep. It's area code 937 here in the Dayton area, and we're at 294-1415.
937
294
294
1415.
1415.
Pretty easy.
And all they have to do is ask for you, Randy,
Just ask for
right?
Randy. Mhm.
Okay, that's
Yep.
great. Viewers, we're concluding this incredibly interesting show today on long-term care with Randy Gallas, who is the president of the Long-Term Care Agency in Kettering, servicing Dayton, Cincinnati, and surrounding communities. And I hope you have taken a pause to do a little bit more than consider as you look at your portfolios, as you look at your forward planning. Please, please do not eliminate this critical component. You buy car insurance and you don't get into car wrecks. The statistics say that. You buy homeowners insurance to protect you from a fire, and the statistics say rarely used, but you would never want to be without it. And in the same way, I want you to look at long-term care. This is a policy that, like it or not, you don't ever want to be without it. So as you move forward, I would urge you to consider the information that has been presented today. Do not believe the naysayers, because believe me, they're not going to be the ones taking care of you and your family when things go sour. Take the time to review the information. He's giving you a lot of information. You can call him. They'll send it to